Good afternoon. Welcome to the TheoTRADE afternoon video. I'm Blake Young. Today is May 16th, 2024, and we're going to talk about an industrial revolution and a run on the banks, two sectors that are in play right now. But before we get into those specific sectors, we do want to talk about the fact that the S&P 500 and the Nasdaq have reached new record highs, pushing to these new highs. But you can see today's breakout is questionable, because as we made a new record high yesterday, we pushed a little bit higher and then we've fallen back to close flat. This could be a failed breakout. But the fact is, if the S&P is moving higher and then we're struggling, there's likely strong sectors and weak sectors. So we want to look at these breakouts when we're seeing signs of weakness, when we see no volume and continuation after that, that one, it could be news driven and then we're going to see it fail, or that we have a bifurcation in the market. We see a divergence between key sectors. And so the sectors that we're going to focus on, that we talked about last week as well, are industrials, but we're going to go against the banks, regional banks, and focusing specifically on individual stocks. But to start with, let's go take a look at XLI. XLI, we talked about this last week with the idea of buying industrials and selling consumer discretionary. The pattern hasn't changed. And so if we're not breaking through to record highs on industrials while the S&P is breaking through the highs, then the move higher didn't need industrials to move higher. The move higher, even if it pulls back, shouldn't likely see this one pull back that hard as well. Industrials are likely to continue to get this 1.4, almost $1.5 trillion budget spending bill that is going to push money into, yes, the technology sectors, but additionally into industrials. And so we're going to look at some specific stocks in industrials. At the same time, you might say, wait, you're going against the banks? And if we look at XLF, knowing the interest rates are kind of fluctuating right here, maybe they're going to go lower, maybe they're going to go higher, and people are betting on financials. Financials cleared the high as well. But this is not what we're seeing in the banks. The financials include a lot more than just banks. Take a look at KRE. KRE, the regional banks, and you can see we're not doing nearly as well. We're not approaching the highs. We're struggling in a gap area, and we're showing a lot of weakness. So this is the reason why we're going to go long industrials and short banks, regional banks specifically. To start with, let's go look at industrials. Now, there are a lot of stocks to look at. We've spent plenty of time talking about aerospace and defense. I'm not going to spend any time in that sector today, except for GD, General Dynamics. Additionally, we're going to look at some other things that are outside of that area for other opportunities, some potential bullish moves and continuation higher in spending, government spending into the industrial sector. Now, I do think things like the electrical equipment area will need to grow, expand, if we're going to see AI and technology continue to grow. We're going to have to see things like Eaton Group and Emerson continue to move higher, and those are the two that I'd probably focus on primarily. And we can look at those charts. As you can see, Eaton Group already broke through the highs and has retested a couple of times. I'm not going to time an entry on this one yet. I think this is a tweezer pattern, and we could see a pullback, maybe an opportunity to buy again near 320 or 310, but definitely something to pay attention to over the next couple of days or next couple of weeks. Emerson Electric is pulling back as well, and I'm looking for it to fill this gap. If it defends the gap, we can buy at 112, but probably a retest of 110. So these are not the ones I'm timing to, but it's something to pay attention to. I don't want you to lose these. Keep these on your radar in the electrical equipment sector. But like I said, we're going to start with GD, and we're going to go with General Dynamic. General Dynamic looks almost identical to the industrial sector. General Dynamic also is a big, because it is a military contractor, it's going to have big contracts with the U.S. government. We've created this pattern through here. This is whether you want to call it a cup and handle or whether you want to call it a ascending triangle. Simply getting through this high is enough to push us the distance of this pattern in its entirety, arguably all the way down to this low. I'm going to cut that off at about 282 instead of going down to 272 or even 280. Let's go with 282 up to this close of about 296. So I'm looking for about a $14 move. And a $14 move as a minimum for General Dynamics should give us an opportunity to be able to trade that higher, collect some premium on options when we do get approaching to that previous high. But the stock itself, we could be looking for a 5% breakout in very short order. I don't think that's going to be too hard for us to reach a 5% breakout on General Dynamics. And then option premium on General Dynamics, if you look down underneath today's option statistics, whoops, you're going to see the current implied volatility is 41%. Anything above 30-some%, I want to be starting to look at selling premium. It's not very high, but it's high enough that we should be able to work some short calls as we approach maybe that 312 area as we push up that first $14 move. They do offer a dividend yield, but that's just a secondary bonus if we get there. I like General Dynamics. I think it's got the contracts behind it as far as the government contracts. I think we have a nice price pattern. We only have to move a little bit to confirm a potential $14 move, which is going to be more than 5% for this particular stock. We're going to go ahead and look at BAH, and we'll stay here on the options just so you can see the options and see that the implied volatility is currently at 60%. So current implied volatility percentile tells us we probably want to look at selling premium if we can. There's just not a lot of options on BAH. So let's take a look at the chart. BAH already broke out of its pattern, the ascending triangle or cup and handle type pattern. Already broke out, climbed, fell back, and retested the previous breakout. That's what I would define as a retest of the previous resistance, now as support, because yesterday it gave you the bounce. The continuation should be able to go from about 139 back to the breakout, about 149, so a 10-point move. We've already bounced up 3, but I don't think this is out of control and too high. I think we still have an opportunity not only to trade for the remaining $7 to $8, but probably a continuation higher of this trend. Now, can I sell some premium against that? Well, we could sell the at-the-money put because we are getting paid a higher premium. So if we look out just to the June contracts, the short put at 150 is going to pay you 2.5%. We are looking at this to move $10 on a 150, which is about 7%. So if we're going to get a 7% move on this, that could take months to do, or we can get paid 2.5% for just simply saying, I don't think it's going to go back below 150. I think either trade is reasonable. I think they could both be done. Sell a put for one contract to collect 100 shares potentially, and just buy the stock here, looking for it to go from 152 up to about 159, 160 for another $8 move. The last one from industrials that we're going to look at may surprise you. Maybe it doesn't. But I was initially kind of bearish on UPS because I thought consumers were going to slow things down. But I liked the bounce that we got today in UPS. UPS has rallied, pulled back hard, rallied, pulled back hard. And you see how clean that low is. The gap, the low, the close, right there, 147.97. We could really just call the close price 147.94. That looks very promising to me as a strongly defended low. We broke through it, tested as resistance over and over and over and over again. We broke out and retested it 4 times, even tried to push a shadow through there and then recovered. So I actually like UPS as a buy opportunity as it sits today. I do think the opportunity for UPS could go all the way back up to 158 in the next couple of days, if not week. And as we're looking at the implied volatility going for UPS, UPS is currently at the 36th percentile. So I'm not looking to sell puts to get into this. I would be interested in buying an in-out spread or just simply buying the stock for the move of another $9 to $10 move higher. Now, despite the fact that I think industrials are going to do well, which usually means that we're going to look at growth and expansion and therefore lending, I don't think the banks are ready to respond and get the benefit of that bullish move in government contracts. The governments don't borrow money from banks to grow. So if it's government contracts that are driving industrials, I'm not betting on banks doing well here. Banks do well when corporations are borrowing and expanding, not, and as well consumers, but not government spending. So as we're looking at this, we're looking at some of the regional banks. We could go into ignoring the financial services like Berkshire and Visa. We could go into the individual banks here and look at the regional banks. And I just think the regional banks that you have over here, the ones that are going to be the weaker ones and struggling, or Wells Fargo. Wells Fargo always seems to struggle, but the regional banks are the ones I want to focus on first. So back to KRE, and is this enough of a price pattern? I like the gap up, the close down. I like the follow through. I really would like to see KRE clear the low near 550.66 to be able to take a position on KRE in general. I think we could just take a position on KRE and not worry about getting the individual stocks. But we're going to look at some of the individual stocks because their setups look a little bit better. You'll notice that on some of these regional banks, they look very similar. We take something like Truist. Truist is up near the highs but couldn't break through, but pretty positive. I'm not going to bet against Truist yet. But M&T Bank, HBAN, Huntington Beach is almost the same. Tweezer pattern at the top. Regional Financials is a gap down, trade flat. So again, none of these have cleared that low, but they're certainly set up for a pullback. And CFG, Fifth Third, FITB, Fifth Third, and you'll see the patterns are very much in a topping pattern from the perspective of running up to these key highs. Now the question is, which ones are going to give you the better opportunity? We don't have to bet on a flat out short position or a long put. We can actually sell a premium against some of these. And we can take the time to look at the implied volatility and say the current implied volatility for Fifth Third Bank is 33%. You can take the MTB, and you can see that it says 0%. So the very bottom says we should be a buyer here and probably a seller of something like NU. Now NU has a 53% implied volatility and lots of options that we can trade. So NU has a higher implied volatility, lots of options that we can trade, while MTB has a 0% implied volatility. So we want to be a buyer of the cheap options and a seller of the high options. That's what we're going to look for on these setups. So going over to MTB's chart, we can certainly look at it and say, I like the idea of potentially going bearish back to 145, and where the calls and puts have an implied volatility of 0%, we're at the 52-week implied volatility low, then that might give us an opportunity to simply just buy a put or buy an in-out spread on MTB for a bearish trade. Taking a look at MTB's options, there's only month-to-month options, so we'd probably go out to the June contract, and we want to collect enough premium towards our target to pay for whatever we're buying in the money. Selling the high, saying that we've already put in the high, we could buy the 155 put at 55 here, or the 160 put. I like to do deltas closer to 70, and so I've got a 75, so the 160 and sell the 145. What we're doing there is we're collecting more premium of extrinsic value than what we're paying for the long put. This creates a $15 spread that only costs us $5 and it gives you an opportunity to make almost 10 and double the risk money for a trade just back down to support. But you're also not collecting, you're not paying any premium, you're not paying any time decay, you're actually collecting time decay at that trade. But take a look at NU and we can see the same chart. Same kind of reversal potential. We would like it to get through that low, but because the implied volatility percentile is so high on NU, I don't need to buy the trade. I could sell the trade. So we're going to sell up here. NU has a surprising number of options, even though it is only a $12 stock, but we want to collect the premium that we can. And if we were to sell a month's worth of time at the money, because we want to collect as much money as possible, I usually don't go with 45 deltas. It's usually less than 42, but we'll use 45 for this example. I can sell the 12 and protect myself with the 14. Now that's going to create a spread that's only 31 cents, but it's collecting 31 cents. The risk is $1.60, $1.70. If it doesn't move, we collect 30 cents, and we'd have to go through record highs. We'd have to go all the way up to 14 before we're in trouble. If you wanted to do the $1 wide spread, you do the 12 by 13, and the cost credit is 23 cents. It's a couple pennies light from what I normally want to do. I want 25 cents per dollar wide generally. But we're selling the 12, buying the 13, which means as long as we stay below record highs again, then you're going to collect that 23 cents. And it's a about a 33% return on risk. It's about a 30% return on risk on something that is paying out a little bit higher premium than MTB. And like I said before, one of the things that I like to do, I definitely think that we can always look for something short or bearish in Wells Fargo. They seem to have trouble at the peaks. And if we look at Wells Fargo and the implied volatility associated with it, scrolling way down, I know it's not considered a regional bank. Current implied volatility is only 11%. And if we look at the chart, that means we want to be a buyer of options if we can. May give us an opportunity for an in-out spread. And if we're looking at this, this is a big reversal candle. Huge. Failure on the breakout, small little body. We've filled the gap. We've traded all the way back down to the lows. I like Wells Fargo for a bearish position. And despite a very large, almost 2% sell-off in one day, Wells Fargo's implied volatility really hasn't gone too high. So let's do an in-out spread on Wells Fargo, and we'll go out the same month time period. We're going to buy a delta closest to 70. Well, this is 14 away. This is 9 away. So we're going to buy the 62.50. And I'll show you by changing our layout from delta, gamma, theta, vega to intrinsic, extrinsic. If we buy in the money a little bit further and we're selling the extrinsic value, you'll notice I can buy, leave it at 62.50, and I'm paying 76 cents and I'm still collecting 86. So that one is fine. It's just kind of on the edge for me. But we're not paying any time decay. If we want to buy a little bit deeper in the money, if we bought the 65 and sold the 60, that means we're paying 14 cents of time decay and collecting 87 cents of time decay. So this turns into a positive theta position that is going to cost us $3 for what could be worth $5. So pay $3 to get $2, but it's a positive theta. Or buy the 62.50, sell the 60, and it's pay $1.20 to get potentially $1.30. So it's better than 1-to-1. You're buying at the money, selling out of the money, and you are still in a slightly positive time decay situation on Wells Fargo. Well, that's going to do it for me today. Thanks for watching. Join me tomorrow morning for our TheoTRADE morning live show, and again next week for the Thursday afternoon video.